take a deep dive into a company in the small cap space. And for that, we have Shaw and Partners senior analyst Philip Pepe joining us, who has Hello World on the mind. Am I correct? Hello World, after its upgrade coming through last week. That's the second one, correct me if I'm wrong, this year, isn't it, Philip? Nice to see you.
Nice to see you, and hello Nadine, hello World. Yes, second one since their August update, and we think potentially one more to come. It's in an interesting space in sort of the travel space with the focus on leisure. We've all seen the horrific period that many of the travel sector went through during COVID. We saw that in the Qantas results with what happened with Virgin, Flight Centre, etc. And we seem to be coming out of it a lot stronger than what most people anticipated. It's always bigger to forecast a recovery. You can never be certain as to how quickly demand returns and how how people change their spending habits. They are largely a leisure travel company. They do a little bit of business, but it's mostly leisure. But if you look at the stats that are coming out of airports and a lot of the travel retailers, demand is remaining strong and coming back more quickly than analysts forecast. But we're still at, people like to compare current stats versus 2019 because it's pre-COVID. The travel stats, or the main travel stats, we're still at about 70%, 75% in some cities of where we were in 2019. So we're not travelling yet as much as we were before COVID. The reason that things are recovering is travel restrictions are starting to be removed globally. People are feeling better about travelling. People have had their second, third, fourth jabs, just getting used to living with COVID. Leisure is proving far more resilient than first thought. It's not the first thing people give up. We've still got full employment. Some data out today shows that housing prices are starting to recover despite the interest rate rises. So the wealth is holding up a lot stronger than we thought. And we've got inbound tourism or inbound foot traffic recurring. You would have read about 300,000 to 400,000 immigrants coming to Australia this year alone. That's only going to grow. So what that means is demand for travel and tourism is back on the rise. And because of the increased costs in some cases, people are planning more complex trips for longer durations, 12 months out. So total transaction value is actually going up, which is great for some of these travel stocks. So to some extent, analysts weren't certain how the supply-demand response would play out. But it seems to me like people aren't giving up their travel. We've all heard anecdotes about people taking their children out of school to go to Europe or somewhere for 2 or 3 or 4 weeks as opposed to a week in Bali. And we're in stronger for longer. So in terms of Hello World, which we like, covered by a colleague of mine, Data Eunice, we upgraded our share price target last week to $3.40. The company has upgraded twice already since its August results last year. It's the extent of the upgrade has been about 67% on average at the midpoint since it's first put out its guidance because of the increase in recovery. Interestingly, the quarter just gone, the underlying EBITDA was a little over 14 mil, almost half of what it's guided to for the year. And to get their full-year guidance, or the new full-year guidance of 38 to 42, that implies a slowdown for the fourth quarter of around 8 to 12 mil. So if they have a repeat of the third quarter performance or grow from the third quarter, they could very much upgrade again into their full year results. So we very much like the space. We like Hello World. Has no debt. It's attractively priced versus its peers, and a company that's just delivering. So we're very much a fan of Hello World at the moment, and I'm hoping to be a customer of them in the next 12 months. I can use some of their services.
Yeah, well, okay, there's an endorsement, money where your mouth is, so to speak. But you do mention that third upgrade possible, noted. But I'm wondering, I know that you still think it's relatively cheap, or is that backward looking? Because if I look at the past 5 days, the share price is up by 16%. I mean, is it looking a little less good value today at $3.14?
The upgrade that came through last week was pretty material. It was a mid 30% increase to their guidance. the share price is not up by that extent in the last few days. So we were a little surprised when the announcement came out. I think the share price was up 5% on the day, despite a material, call it 30% increase in EBITDA guidance. So I think what we've seen in the last few days is people realising, gee, that was a bigger upgrade than we anticipated. Analysts, investors need the time to do their work, and they're realising that, hang on, the market's not fully pricing in what the company's guiding to. So, I mean, our price target is 340, so we think it'll keep going. That's based on the current guidance. So if they have another strong fourth quarter, we'd expect upgrades to come through again. So how strong can it be? Just a repeat of the current quarter is an extra 2 mil that puts the EBITDA into the low to mid 40s. So yes, it's had a good run, but there's a lot of tailwinds. As we said, we're still at 75%-ish of the pre-COVID levels of demand. We've still got tourist population coming back to Australia. So a lot of the products they sell are internal touristy products, cruises, site visits, that kind of thing. So we think it's still got a little bit more to run, and the more people realise that it may become another positive announcement with its full-year result, we think it'll keep running further.
So interesting, because also if you think that we don't have Chinese tourists back significantly, like there are still parts of this world that have not returned in any significant way to visiting us down under. So you would prefer that over Flight Centre, Webjet, corporate travel management, part and parcel because of the price, a 45% discount to some of its other listed peers. On this sort of period that we're in right now, do you think we're sort of in confession season, Philip?
Absolutely. Look, absolutely. I mean, Hello World put out a trading update last week, and that was positive. So
yep.
as we approach 30 June, we're now in May, so a lot of the recurring revenue companies or contracted revenue companies will know their full-year result, if not by now, certainly in the next 4 weeks. Hello World, because of their current size of their, call it order book, they had to put out a trading update last week. So they are stronger than they were initially expecting. That demand for them will only grow. And similarly would apply, we don't cover it, but similarly would apply to the other travel stocks like Flight Centre, Corporate Travel. Qantas has been doing well. So you'd expect demand to continue to grow, because we're still, what we haven't seen yet is, in a lot of cases, the cost of travel is actually still quite high and prohibitive for some people. So as we get more capacity come on and prices return back to pre-COVID levels, you should see demand continue to increase. So yeah, we're in confession season, but companies like Hello World that don't have any debt, so interest rate rises aren't going to affect them. They've had their cost issues with during COVID. They will see some cost pressures come through, but their top line's growing at a far greater rate, and their EBIT margin is approaching 30%, which is fantastic, up from around 20. So they're actually doing well, and we think the travel sector, let's call it earnings surprise season, could possibly surprise again on the upside, given that analysts can be slow to upgrade. But we think this sector is actually stronger for longer, or certainly for at least for the foreseeable future. Call it 12 months.